What's going on, guys? It is Friday morning, 8:30 a.m. Love making videos on Friday morning. Happy day. Um, we've got a 10-year gym slash fitness center financial model I've built here. Spent a good amount of the week on it, and I'm really excited for it. So, I'm just going to try to walk you through an example of how I would actually use it. There is, an index here that explains each tab, more detailed instructions, but let's just get into it here. So I want to start a gym. So what do? Well, first, what year do I want to start? So I'll enter a date here, and all that's really going to pull from this is the year, but you have to put month, day, year, no matter what you do. It's still gonna basically this drives all the monthly drop downs over whatever 10-year period, so it defines the monthly range. So I just put it the first day of the year I plan on starting would be fine. Then you've got the revenue start month. So let's say you plan on starting in 2018, but you don't think you're gonna have members start signing up and paying until whenever. This is your runway, so let's say not till July. That's going to affect all the numbers. So let's say we start in July for revenue, but between January and July, there's probably going to be some costs that go out and so forth. So this executive summary tab gives a high-level look. It says, startup costs are 1.5, financing this much, you need this much equity. You're going to have some burn, which is basically net losses on a monthly basis, which means you haven't covered all of your monthly expenses with your revenue, so you're going to have to come up with more cash. And then you've got your total equity needed, which is going to be based on all your assumptions. This is the minimum amount of cash you need to get this thing going. And obviously that varies based on all the assumptions. And then the only other part of this tab that's important for building the scenario is your exit month. So let's say I think this goes over 10 years. I'm going to go out in the last month of the 10th year, and then I'm going to value the business either EBITDA multiple or percentage of revenue, and then you put in the multiple here. That gives you an exit value, which will also affect the net equity position at exit, which this net equity position takes into account the fact that you have to pay the loan back at exit if it's got a balance, if there is a loan. There's also cash flow in from possible sales of the building, and then obviously the cash flow for that year and the cash proceeds from selling the business itself, which is defined here. So this would be the net cash flow before tax, the project internal rate of return, or IRR, return on equity, which is just taking the net cash before tax divided by your initial equity needed. So this is basically saying if you have a bank account, you put $2.8 million into the bank account. At the time of exit, the bank account now has $15,600,000. So that's what that means. Then we've got just discount rate, and this is to kind of give you a value. So say your required rate of return is 15%. That means the net present value of the future cash flows will be $4.8 million, which means there's a perceived value of the business of $3.7 million. Now this works right in with the internal rate of return, because you can see if you do project IRR, if I copy this into the discount rate, the perceived value would be 0. You can see because this is what you have to discount the future cash flows at in order to come up with the initial equity needed. Now the reason why this is $1,092,000 and not 2.7 is because you see on the monthly we're actually saying this is the amount you need. Less the financing. So, and obviously, financing, this is probably going to be assumed to start whenever all the cash outflows start. So there's your 1,090 or 1,092. And you also have negative cash flows going forward. So that's to say, you're gonna have to have a reserve if those numbers are, if this 2.8 is not the same as this initial startup cost of 1,092. Because you can see there's negative monthly cash flows going forward that the business is operating under, assuming, this is all based on the assumptions. You could do assumptions that have you making a profit every month for the beginning. Now, obviously, there's profits as you move forward because this model is you can scale with it, but at the beginning, it's saying there is going to run a net loss. So that's probably the most complex part of the whole model, is understanding that, but all the math works out. So you can just keep looking at it, checking it, and seeing for yourself until you get it. That's what I had to do. So this is just a 10-year summary. You've got your total revenue, total expenses, EBITDA, pretty much as simple as I can get. These are your main operational, the meat of the business. But there's also other activities, cash flows that affect the business, like debt service on the loan, capital expenditures for like expansions, the exit value of the business. So all those things are taken into account there. The building sale. And then you get some charts here. We got key financials like revenue, expenses, EBITDA over the 10 years. Accumulated cash. You can see every dip is basically a big capital expenditure. And then the orange, I think that's orange, I'm colorblind, but that is your running cash position over time. You can see that should be, let's see if we can get the number there. .6. Those blue lines you barely see when there are the monthly cash flows that make up the total accumulated cash position. Well, it doesn't want to show me that number. This should be, let's see, that line should be close to 5. Accumulated cash. Let's see, let's make sure here real quick. Where are we at? Running cash position. Yeah, that's should be going all the way over to 18 million. What's the problem there? Select data. Okay, yep, 13. Running cash position. 18. And months, did we go all the way over? Yeah. I'm going to need to format this to every 3. Let's format it every 2. We have to make the font smaller. Because it's not showing the last cash flow. Alright, 1 second, I'll fix this. 1 second. Okay, there we go. So now you can see there's the big exit value Problem was I didn't have the date axis going all the way over to D, but the cash flow started in D, so it just screwed the whole thing up. So now it's fixed, perfect, and that makes sense because I'm saying, this number should be close as 18 million, should be right up against this net equity position, which it is now. Okay, so that's good. I'm glad we got through that, and this is the purpose of going through this model, is just to give it another overview anyway. Next is the member summary, which is showing you basically the bars are your ending subscribers at the end of the year, so you can see how much it's gaining. The added members is the blue, and actually probably should change that. To some other color, black. There we go. So that's your added members, and then this make these black is your lost members, because obviously every single member that joins is not going to stay forever. Here's your debt service coverage ratio, and then the amount of EBITDA you're making per user. Okay, so that's the executive summary, 10-year. Next we have startup costs. So this is saying, okay, well, I've got, am I going to have to do a building construction? That could be $1 million too. The numbers will vary. Obviously, you might not have any construction or buildings at all. You might be renting somewhere, which means this would be zero. Then I've just put in some costs here for construction, permits. Then we've got the actual gym equipment, bench machines, fly machines, so you could enter the count and the cost of each of those, and that all populates here. And you can obviously change the names of any of these descriptions, no problem. And then it just totals up your costs down at the bottom. We've got a total of 77 possible fields to enter, so that's probably enough. So that will flow into the model. That basically goes to the startup costs right there, which is going to affect the year, the cash flow to start. And then you got financing. So how much you're going to finance, you can put 0 here and then not have any financing. You can see how that affects it will probably lower the internal rate of return because you don't need as much, or you need more cash up front. 3.2. And then you wouldn't have any debt service coverage. Would not affect the EBITDA. So you could put 0 there. We could put, say, $1 million. Look how that affects it. You see your equity requirement is now only 2.4 instead of up in the 3s. You've got debt service coverage now because you've got debt service per year, $75,000 a year. So there's your financing. You can obviously adjust the interest rate, the term, payments per year, and the month you start. Could be any month. The idea of the model is that you can really, it's got room for really doing some dynamic sensitivities and trying to build your case and see what that looks like financially. Now we've got running costs. So here we've got, you can enter the description. We've got GMs, CEOs, trainers, employees, whatever cost. There's a total of, how many fields there? 46 fields. So you enter the description. You could change any of these to whatever you want. You pick the month that you plan on them, the cost starting, which if I put January for GM or Gym Manager 1, you can see in the monthly. If I go to Gym Manager 1, that starts now in January. I've got the rest of them starting in March. You see here March. If I change this to say July for Gym Manager 2, you can see now, look at Gym Manager 2, doesn't start until July. And now these are, you can see these are the monthly costs, and they'll change each year based on whatever is put in. So if I go to here, I've got 1,000 across the board, but if I were to change the running costs, say they're going to get 1,000, next year they're going to get 1,200, then say 3,000. You see in the monthly that will now change. You see 2019, now they're getting 1,200 year 2, 3,000 in year 3. So all that functionality works for all of these on the running costs. So you pick the month and pick the amount, and so each year you're just defining what the monthly amount is each year. So in year 10, who knows, they might be getting 5,000 a month, so you put 5,000. That works for the same for all these, and there's, like I said, up to, what did I say, 20 or 46 fields. Next is CapEx. So this is if you're going to do upgrades, expansions. You can see I put, like, say, for the amount of users that were expected, we're going to have to build another building here, here, and here. So I've put, you know, August 2020, September 2024, October 2027. So these costs are one time, and you would pick the month that those happen and enter a description. And you can see over the monthly that would flow right here in the CapEx, and you can see if we go over to those months, you see there's September 2024's that came in. But those will affect the cash flow after running off of, you know, EBITDA. Then you got to take off your debt service, then you take off your CapEx, then you take up starting costs, building cash flows, everything to get down to the bottom. Cash flow after all, as I call it. Okay, so there's the CapEx. Last part, probably the most important, is your revenue. So 35 is what you're going to start at, and this will be based on the start month of revenue here. So you can see right now it's set to July. So if we go to the monthly and go up here, nothing is happening until July, and it's 35 to start. Let's say I want to change that to March, or let's say April. You see now April in the start month is 35, or start amount. If I change this to, let's say I only have 15 to start with. See there, just changed to 15, and if I change this, it could also adjust June. Now it's 15 starting in June, and then I'm adding 25 per month in year 1, and I'm losing, you know, whatever percentage, 3% a month, and I'm charging $55 a month. So these are the main inputs to drive your revenue, and you can see if I scroll over, it's 25 a month. Next year, I'm going to say 35. I can add a month, and then 45, and etc. based on whatever you put into that schedule on the revenue tab. And then you've got obviously a churn here, and you've got an ending members amount. You can also now attach dollar amounts to each of those members based on your revenue. And this is assuming you're going to start charging all your members this revenue figure as you move forward. So you've got, you know, added revenue is the revenue from new members, lost is the revenue from lost members, and then your ending recurring revenue is the revenue from whatever you've got left after your gains and losses for the month. So it's kind of like a SaaS model, but it's for a gym. So it's a bit simpler. Try to make it as straightforward as possible with one pricing level. So there's your revenue. That's all your revenue. Then we've got the running costs flow into here, and this is on the monthly tab. Running costs, EBITDA is just basically saying revenue minus regular operational costs. EBITDA margin, other cash flow items. We've got debt service. So how much you paying on this loan? If we put this back to 0, it'd go to 0. You see there now it's 0. Cash flow after debt service. Then we got the CapEx. And so this is a great way to plan if you want to know when you have cash flow available. or cash inflow from the business that will get you to a point where you can start doing some more capital expenditures. Or you can see how much equity you're going to need to survive the capital expenditures that you plan, while taking into account the fact that you're going to have monthly cash flows from your business operation once you start. So that's really important in planning out in your head what you want to do and when you might be able to do it. What else? So here's the loan balance, and that's going to be important because on the exit date, which we currently have on December, but we could put it at any month dynamically from the executive summary. It's like I could put in, let's see, November 2025. And obviously this capital expenditure would not be there if I'm selling in 2025. I would put this at 0 for 2027, obviously. And so if we did exit 2025, we'll go to the monthly. It's saying at that time, you know, we got $1 million coming in from cash flow from the building because we put that in there. It doesn't really matter what year you put it in, it's still going to just give you the total, but this is to help you better know what's happening each year, just for your own purposes. Let's say, so was that year 8, I think would have been 2025. So you get $1 million from there. You've got exit value of the business, which is taking a multiple of, or actually a percentage of the revenue. Let's say 0.5 is more realistic. So 1.3, so that's saying 50% of the revenue, which is 217,000 times 12. So I'll give you this calculation. So 217 times 12 is 2.6, but then you have debt, so you got to remove the debt, which is at, actually, do we put a debt line? Oh, no loan balance. So we've got the multiple, hold on, we're saying the exit value is 1.3 because, what was that multiple of 2.6 times 50% is 1.302, and there's your number. And I didn't, there's a couple $100, I didn't mess with that decimal place or those first 3 digits. That's why it's not exact, but I mean it is in the model, it's not in my ad hoc calculation here. And then you simply add the building cash flow to that number to get your exit value. And then the 2.4 is simply taking the exit value less capital expenditure, because this is the last line. This cash flow after capex is the last line after you've taken out the capex and debt service from the EBITDA number. So we end up with, since we're adding another 185,000 for that month, with 2.487 million. And if you do this minus this, should be that 185, which it is. Okay, and that's, I mean, the basic, all the logic in the model. Then we've got some metrics here: EBITDA per user, interesting number. You can see how much of the money your user's paying is actually hitting your earnings before interest, tax, depreciation, amortization. Okay, so I think that's about it. I'm pumped about the model. I always wanted to start a gym myself, but never have. Cost a lot of money, and it's tough, but who knows, you might want to be doing it, you might be able to. So this model should help you in planning. And then real quick on the purchasing, when you go to buy this template, I'll have a link in the description box that will take you to smarthelping.com, and I'll have an individual page for the gym. It'll be under industry specific models once I add it. And the way the download works is once you pay, you'll be taken to a download page, and the download page will give you it'll take you directly to the download, or take you to a page on Smart Helping that has links to downloads. It could be multiple downloads if there's multiple models that are included in the purchase, which are like for some of the budget. I think the budget and the Gantt schedule. There's a couple downloads involved in that purchase, but for this one it would just be one. So you'll be taken right to the download page, which is basically a Google sheet, or Google link that allows you to just directly download the Excel version, and it'll take you to that after you make the purchase. Now, if you have any issues, I can always just directly email you the template after you purchase. And you can see this template download help tab, which I've added to help you see how it flows. I've also done a video specifically on how that works and what pages you would see when you're going through the checkout process. So those are newly added since my last model, so I figure I'll give you the update now. And then this model, the gym model, or fitness center gym, it's going to be a intermediate level. So that's the first one of its kind I have on the site, which means it's going to be $75 one-time cost. And my upper tier is $125, my mid-level is $45. This is going to be intermediate, so it'll be right in the middle. I think that's the fairest price I can come up with, based on the value I feel it's worth, and the time it will save you if you're trying to start this from scratch. I mean, if you value your time even at $30 an hour, you're saving hundreds of dollars by starting off with this. Alright, that's all I got for you. SmartHelping.com here. I'll see you on the next one.